Okay, now in our entire group assignment, right? Let's say that we've gone through the perpetuities. Now we'll see how we compute the free cash flows. This is the output. This is the output which we have arrived at. Now we're going through each of the components. So let's see that we've said that the free cash flows of Facebook is about 11,118.05. Now let's just see how we've come to this figure. Yeah, this is the place where we computed. Now if you see the session notes, right? Let me see if I have that open. Yes. Now this is what the prof had mentioned. This is in valuing companies, and I guess it's about page 7. So this is a way we compute free cash flows, which is EBIT, earnings before interest and tax, into 1 minus tax rate, which gives you your net operating profit after tax. From that you subtract capex, subtract working capital changes, and add depreciation. Depreciation or any other non-cash item, if you add, then you come to free cash flows. So what we've done in our example is just translated all those things into simple Excel formulae. We've said that earnings before interest and tax, this comes straight from our P&L. Where is the P&L? Here it is. See here, we've got earnings before interest and tax of 12,427. So we take that straight into our computation of free cash flow. Arrive at what is the expected, what is the tax rate that is used. We take the current income tax, how much has been provided in the books, and what is the pre-tax income. Tax is computed on pre-tax income, so we arrive at what's the effective tax rate. We find out that it is 22%. So on the earnings before interest and tax, we're saying that 22% of that will go to the tax authority. So of the 12,427, once you deduct tax, you're left with 9689. That is available for your banks and the equity shareholders. So from this 9689, we've got to make adjustments for non-cash items, because the company doesn't spend actually any cash towards these items. So we say that these are just provisions. These are just the company being a little conservative and saying that my profits are lower, but actually cash has not been spent towards the 6473. So we make adjustments for depreciation and other non-cash adjustments. This figure also you will get directly from the cash flow. Where is our cash flow? Here it is. And there you see 6473 non-cash adjustments. So we take that value, we put it right here, and then the working capital changes. The changes in working capital is also right here in the cash flow. We take that, changes in non-cash changes in working capital. We put that also as 553, which is an outflow. And the last thing which we wanted was a capex. So capex also how much the company has spent in fixed assets. We pick that figure also up from the cash flow, 4491. So what we've done is that we've got all these values from the P&L, balance sheet, and cash flow, and we compute the free cash flows of Facebook. This is at the end of This is as at 2016. So we take the earnings before interest and tax, we compute the effective tax rate, we deduct the amount of 1 minus t is nothing but the post tax rate. So after excluding 22 percentage, how much do you get? So 12,427 into 1 minus tax rate gives us 9689, from where we got 6473, 553 and 4491, which is non-cash adjustments, working capital changes and capex, straight from the cash flow statement, and we arrive at free cash flows of 11118. Simple as that.